You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. Today, we are getting our hands dirty with waste management. It is the fourth quarter of 2025, and today is January 29th, 2026. Honestly, for a company that hauls trash, this report was surprisingly clean, or maybe just efficient. Miro, what's your read? Because looking at the tape, the market seemed to have a bit of a mood swing this morning.
Mood swing is polite. Look, the headline numbers were solid, but the reaction was a classic sell the news event. The stock gapped up at the open to around 228 and then just slid all during the call. Closed the day down about 2.5% near the lows at 223. As for the actual print, it's a mixed bag. Revenue came in at $6.31 billion. That is actually down 2% from the third quarter. But, and here is the trick, earnings per share jumped to 183, up from 149 last quarter.
So wait, revenue shrinks, but profits jump. That sounds like, what, they're squeezing the sponge dry?
You could say that. It's pricing power and cost control. They're charging more to haul less. Operating income was up almost 17% quarter over quarter. They hit a record low on operating expenses as a percentage of revenue, 58.5%. So fundamentally, the machine is humming. The market just didn't like the price tag attached to the stock this morning.
Right. It's like buying a perfectly good garbage truck, but paying Ferrari prices for it. And hey, before we get too deep into the valuation weeds, just a quick reminder to everyone listening, this isn't financial advice. We're just two people looking at numbers and sharing opinions. Please do your own research before you trade anything. Okay, back to it. There was one number in here that made me do a double take. Miro, the healthcare solutions segment. You know, the old Stericycle business they bought?
Oh, yeah. That is the story of the quarter.
The margins. They went from, what was it, basically 1% a year ago?
1%. It was barely a business. It was a hobby.
Right. And now it's 14.1% in a single year. The CEO, Jim Fish, had this great line about it. He said they, quote, built a wall between the customer and the messy back office. It feels like they just walked into a chaotic house and organized the closet, and suddenly they found a pile of cash.
It's not just organizing the closet. It's brutal efficiency. They stopped doing work that didn't pay. They fixed the billing. And frankly, that 14% margin, that is arguably more impressive than the main legacy business ticking up a point. It shows the integration playbook is actually working. Which brings us to the other big number, free cash flow. They finished the year just shy of $3 billion, 2.94 to be exact. That is up 27% year over year.
Whistle. That is a lot of cash. And they're talking about next year being the harvest, right? They've spent all this money on renewable natural gas plants and automation, and now the spending drops and the cash pile grows.
That's the promise. They're guiding for cash flow to jump another 30% in 2026. But I have questions about that, because whenever a company promises a harvest year, I start looking for the hidden costs they're not talking about.
Of course you do. You're skeptical of good news. It's your brand.
It keeps me safe. But look, there's also this weird macro signal. Did you catch the green shoots comment? Jim Fish basically said he's dropping the word cautious. He's just optimistic about the economy now. Industrial volumes have been flat for 7 quarters, and they're finally seeing a heartbeat.
Yeah, that stood out to me too. Usually these guys hedge everything. We're cautiously optimistic, headwinds, uncertainty. To hear a CEO say, nah, we're good, the economy is turning, that's bold. Especially since they mentioned the wildfire cleanup business is going away next year, which is a bit of a headwind.
50 basis points of volume headwind. Yeah. No more fires to put out, literally. So organic growth is going to look a little weaker next year just because California isn't burning as much, which is good for the world, bad for the comp sheet.
Tough trade-off. Sorry, shareholders, the forest survived. All right, so we've got shrinking revenue but booming profits, a massive turnaround in healthcare, and a CEO who thinks the economy is back in business. But you mentioned you have questions about that cash flow guidance, and I know you spotted something in the footnotes about how they're calculating EBITDA next year.
Oh, I did. And it's clever. Let's just say not all growth is equally created.
All right, let's get the gloves on. Walk me through the details.
Okay, so grab a pen. This is where they get creative. For 2026, they're taking accretion expense, which is basically the cost of maintaining long-term liabilities like landfill closures, and they're moving it out of their operating EBITDA calculation.
Okay. And how much money are we talking about here?
About $150 million. So, overnight, the EBITDA number looks $150 million better just because they moved an expense line further down the income statement. When they guide for 6.2% EBITDA growth next year, you have to ask how much of that is actual operational muscle and how much is just accounting geography.
That is cheeky. It's like losing 5 pounds by adjusting the scale, not by going to the gym.
Precisely. It's not illegal. It's just convenient. And it makes year-over-year comparisons a headache for anyone not paying attention. But here is the darker side of that coin. While they're polishing up the 2026 numbers, they quietly, very quietly, walked away from the 2027 targets they gave at Investor Day.
Wait, really? The big multi-year plan? I thought that was the holy grail, $1 billion in sustainability EBITDA.
Yeah, about that. There was a footnote H, if you're nasty, that explicitly said those estimates spoke only as of the date issued and are not reissued. Translation, please forget we said that.
That's cold. Why back away now?
Because the math changed. Their original model assumed recycled commodities, cardboard, plastics, would sell for around $125 a ton. Right now, they're scraping along at $70 a ton. If you lose $50 a ton on millions of tons, that billion-dollar promise starts to look impossible. So they're distancing themselves from it.
Okay, so the recycling commodity market crashed the party. But Miro, let's be fair. Recycling is just one slice of the pie. The harvest story isn't about cardboard, right? It's about the cash machine finally turning on. They're guiding for almost $3.8 billion in free cash flow next year. That's a 30% jump.
That part is real, and it's significant. For the last few years, Waste Management has been bleeding capital, pouring money into these renewable natural gas plants and automation tech. That cycle is finally breaking. They're cutting sustainability capital spending by $400 million next year. Basically, the factories are built, the pipes are laid, now they just flip the switch.
So the harvest is literally them stopping the spending spree.
It's more than that. It's operational leverage. COO John Morris said something interesting. He said they are, quote, fundamentally changing our cost structure through investments in people, technology, and process. And you can see it in the credit memo saga.
The credit memo saga sounds like a boring Netflix documentary.
It would be. But stick with me. When they bought Stericycle, the billing system was a disaster. They were issuing massive credit memos, basically refunds, to fix bad invoices. That peaked in Q4. That activity drags down your realized price. Now that the systems are fixed, those refunds disappear. That creates an artificial tailwind for pricing in 2026. So you have falling CapEx, rising efficiency, and phantom pricing headwinds vanishing at all once.
It's the perfect storm for cash flow, even if the accounting is a little dressed up. It sounds like they've built a machine that works even if the economy is just meh. They don't need a boom. They just need to stop building new things for 5 minutes.
Exactly. It's boring industrial competence, which is my favorite kind. Although I do wonder if they generate $4 billion in cash and the stock is already at all-time highs, where does that money go? Buybacks?
They said $3.5 billion returned to shareholders, right? So mostly buybacks and dividends.
But surely there's a risk here. If everything is priced for perfection, the harvest is priced in, the efficiency is priced in, what happens if volume doesn't actually recover?
That is the multi-billion-dollar question. They're betting that industrial volumes have bottomed out. If they are wrong and we roll over into a real recession, that leverage ratio of 3.1 times debt might start to feel heavy.
Right, so they've built a faster race car, but they still need a track to drive on. So where does this leave them heading into next quarter? Are we just watching the cash pile up, or is there another shoe to drop?
I think the shoe dropping is simply execution risk. They are moving from a build phase to an operate phase. Building renewable energy plants is easy if you have the checkbook. Running them at high margins while commodity prices are tanking, that is the hard part. They're forecasting a massive cash jump, 3.7 to 3.8 billion. If they hit that, the valuation makes sense. If they miss because a few plants get delayed or industrial activity rolls over, that 30 PE multiple is going to contract very fast.
Right. It feels like they're walking a tightrope, but but it's a very wide, stable tightrope made of 10-year garbage contracts. But seriously, looking ahead, that CEO comment about removing the word cautious really sticks with me. If the industrial economy is actually waking up even just a little bit, Waste Management is the first to see it. They're basically the pulse of the physical economy.
They are. If factories are making things, they are making trash. It's a simple correlation. So, for next quarter, ignore the noise about the wildfire cleanups disappearing. We know that headwind is coming. Watch the base business volume. If that turns positive after 2 years of being flat, that is the buy signal. Also, watch the commodity basket. If cardboard prices stay down at $70, that accounting magic we talked about earlier is going to have to do a lot of heavy lifting to keep the growth narrative alive.
Right. So the verdict, it feels like a company that's graduated. They bought the expensive toys, they fixed the broken healthcare business, and now they just want to sit back and count the cash. It's not exciting tech growth anymore. It's aggressive stability.
Aggressive stability. I like that. It's the kind of boring that lets you sleep at night. Just don't look at the valuation too closely before bed.
Deal. Boring is beautiful, Miro, especially when it promises to return $3.5 billion to shareholders.
All right. That's the reality of the trash business for Q4. Dirty work, clean balance sheet.
And plenty of free cash flow to wash it all down.
Exactly. And hey, speaking of machines and humans working together, stick around for a quick word on how we actually put this show together. We'll see you in a second.
Hi again. Before we close the book on this episode, I want to take a moment to pull back the curtain a little bit. Earnings Unscripted is an experiment. We are a small team of enthusiasts exploring the frontier of AI. Not just to see what it can do, but to see how it can be used to actually enrich us. To be transparent, this episode was created by a team of AI agents. From the research analyst who dug through the filings, to the scriptwriter who drafted our dialogue, to the fact-checking QA specialist who keeps us honest. It is a collaboration designed to deliver high-quality, up-to-date information at a speed that would be hard to match otherwise. We're learning as we go, so if you have questions, comments, or even if you just want to point out something we missed, we'd love to hear from you. You can reach out at earningsunscripted@datamadness.ca or follow us on X. Thanks for listening, and thanks for being part of the experiment.
See you after the next call.